Imagine waking up tomorrow morning and seeing a message on your phone. Due to unusually high demand, withdrawals may be delayed. At first, it sounds like a technical problem. Maybe the app is down. Maybe the website crashed. Then you open social media. Thousands of people are posting the same thing. Lines are forming outside banks. ATMs are empty. People are refreshing their banking apps every few seconds. And suddenly, a question most people never think about becomes the only thing anyone cares about. What happens if everyone wants their money back at the same time? The uncomfortable answer is that the financial system was never designed for that situation. In fact, if everyone tried to withdraw their money tomorrow, the system would break almost immediately. And the reason why reveals one of the strangest truths in modern finance. Your bank does not actually keep all your money. Now, before anyone panics, this is not a scandal. This is how banking has worked for generations. And oddly enough, it usually works extremely well. Until it doesn't. To understand why, we need to start with a simple example. Imagine a small town with 100 people. Each person deposits $1,000 into the local bank. The bank now has $100,000. Most people imagine that money sitting safely inside a giant vault. Waiting. Doing nothing. But that is not what happens. The bank keeps only a fraction of those deposits available as cash. The rest gets put to work. It becomes mortgages, business loans, car loans, credit lines, investment assets. The money leaves the vault and enters the economy. That's the entire point. Banks are not warehouses for money. They're money-moving machines. And most of the time, nobody notices. Because people rarely ask for all their money back at once. On Monday, one person withdraws $500. On Tuesday, someone deposits $2,000. On Wednesday, a business pays back a loan. Cash moves in. Cash moves out. The system balances itself. Everything looks stable. But stability in finance often depends on one thing. Trust. Not gold. Not cash. Trust. Trust that your money will be available when you need it. Trust that everyone else will stay calm. Trust that tomorrow will look roughly like today. And trust is a strange thing. It can take decades to build. And about 10 minutes to lose. History gives us plenty of examples. In 1930, during the early years of the Great Depression, rumors began spreading about banks failing. People became nervous. Then worried. Then terrified. Customers rushed to withdraw deposits. The problem was simple. The banks didn't have enough cash available to satisfy everyone simultaneously. Not because the money had vanished. Because much of it had already been loaned out. The panic created the very disaster people feared. Banks collapsed. Businesses failed. Families lost savings. Economic activity froze. It became one of the worst financial crises in modern history. What's fascinating is that the first people in line often got their money. The last people didn't. Which created a brutal incentive. If you think everyone else might run to the bank tomorrow, you run today. This is where human psychology becomes more dangerous than mathematics. Fear spreads faster than facts. And banks know this. Which is why modern financial systems have built layers of protection. Deposit insurance. Emergency lending facilities. Central banks. Liquidity programs. Stress tests. These sound boring. Until you realize they exist because governments are constantly trying to prevent mass panic. Think of a bank as a theater. As long as people leave through the exits normally, everything works. But if everyone suddenly rushes toward the door at the same moment, the exits become the problem. Not because the building disappeared. Because it was never designed for everyone to leave simultaneously. Modern banking works in a surprisingly similar way. Now here's where things become even stranger. The money in your account is not always sitting as physical cash anywhere. Most of it exists as digital accounting entries. Numbers moving through financial networks. Which means a bank doesn't necessarily need stacks of cash equal to every customer balance. It needs enough liquidity to meet normal demand. And that's a crucial distinction. Liquidity. One of the most important words in finance. Liquidity simply means how quickly an asset can become spendable money. A government bond may be valuable. A mortgage may be valuable. A skyscraper may be valuable. But none of those help much if 10,000 customers want cash this afternoon. You cannot sell a skyscraper in 5 minutes. You cannot instantly convert years of loans into stacks of banknotes. Time suddenly becomes the enemy. And that brings us to one of the biggest misconceptions in finance. People assume insolvency and illiquidity are the same thing. They're not. A bank can own assets worth billions of dollars and still face disaster. Because assets and cash are different things. A person worth $10 million in real estate may still struggle to pay a restaurant bill without cash. Banks face the same problem. Scale changes. Logic doesn't. This became painfully obvious in recent years. When interest rates rose rapidly around the world, many banks found themselves holding assets that had lost market value. The assets still existed. But confidence started to weaken. Customers became nervous. Withdrawals accelerated. And once withdrawals begin, they often create headlines. Headlines create fear. Fear creates more withdrawals. And suddenly the cycle feeds itself. Financial systems are incredibly sophisticated. Yet sometimes they remain vulnerable to something as old-fashioned as a rumor. A tweet. A viral post. A screenshot. Technology changed. Human behavior didn't. In fact, bank runs may be even faster today than they were a century ago. In the past, people stood in physical lines. Today they tap a screen. Money can leave institutions at extraordinary speed. Panic has become digital. Which raises a deeper question. If banks don't keep all deposits in cash, where does confidence actually come from? The answer is surprisingly simple. People trust that someone bigger stands behind the system. Usually a central bank. When commercial banks face liquidity problems, central banks can step in as lenders of last resort. In simple terms, they provide emergency funding when private markets stop functioning normally. Think of it as financial backup power. Most people never notice it. Until the lights flicker. But even that safety net has limits. Because no institution can manufacture trust indefinitely. Confidence ultimately depends on belief. Belief that contracts will be honored. Belief that governments remain credible. Belief that money tomorrow will still be money tomorrow. And that's why financial crises are rarely just financial. They're psychological. The numbers matter. The emotions matter more. Now zoom out for a moment. This isn't only about banks. The same logic appears everywhere. Investment funds. Bond markets. Corporate debt. Even governments. Many systems function smoothly because not everyone demands payments simultaneously. The world runs on timing. Cash flows. Rolling obligations. Refinancing. Renewed confidence. Modern finance often looks solid because demands arrive in predictable patterns. But if enough people suddenly demand immediate liquidity, hidden weaknesses emerge very quickly. And that's the uncomfortable truth beneath the entire system. The financial world appears incredibly strong. And in many ways, it is. Yet its strength depends heavily on something invisible. Collective confidence. Not blind confidence. Just enough confidence for people to continue behaving normally. Most days, that's exactly what happens. People go to work. Businesses make payments. Banks process transactions. Markets open and close. Money moves quietly through the background. The machine keeps running. But every so often, history reminds us that money is not only mathematics. It's belief. A shared agreement. A system built on expectations about tomorrow. And that leaves us with an interesting question. If every financial system ultimately depends on trust, what happens the day trust itself becomes the thing everyone wants back at the same time?